Welcome to the Deep Dive, the only show that turns a mountain of research into immediately usable knowledge. If you've been investing for any length of time, or well, even just watching the economy, you know the kind of damage market crashes can do. And we're not just talking about money disappearing. We're talking about real psychological scars, careers changing, events that just redefine our whole relationship with risk. Think about the 1929 crash or the 2007-2008 financial crisis, or even that whiplash we all felt in 2020.
Absolutely. Those are the moments that, keep economists and investors up at night. And the one question they all face, it just doesn't seem to go away. Is it even possible to see these things coming? Can we actually build a reliable mathematical early warning system, one that cuts through all the noise?
That is the big question we're diving into today. Because the dominant financial theory, the semi-strong, efficient market hypothesis, basically says no. It suggests all public information is already baked into the price, so trying to predict it is a fool's errand. But our sources today, they propose this rigorous three-step machine learning framework, and it's designed specifically to prove the prediction is possible, at least for the S&P 500.
And they do it by defining a bubble not as some feeling of euphoria in the market, but as a quantifiable mathematical anomaly. In this context, a market bubble happens when the price of an asset just deviates from what its fundamental pricing model says it should be. You can think of models like Black-Scholes as being the tether to reality. When the price snaps that tether, you've got a signal.
So that measurable deviation is the target. Okay.
Yeah.
Our mission today is to unpack how this study first identifies those historical deviations, then stacks up macro data against behavioral data, and finally, uses some pretty sophisticated machine learning to give a verdict on what really drives market collapses. So let's get into it, starting with step one. How do you even label a bubble? I mean, before you can train a machine to predict something, you have to prove when it happened in the past. It's like if you want to predict rain, you need a very clear definition of a rainy day. So what are the tools, the econometric tools they use to confirm the S&P 500 was actually in a bubble?
Well, traditionally, researchers would start with something like the augmented Dickey-Fuller test, or ADF test. It's designed to detect what's called a unit root in a time series. So essentially, it's checking if the series is stable. If a certain parameter is greater than 1, you have an explosive root.
An explosive root. I love that term, but what does it actually mean for our listeners in plain English?
It means the variance in the data points themselves are not stable, they're growing exponentially. Imagine throwing a ball in the air. If it has an explosive root, it doesn't come back down, it just accelerates and keeps going up. That uncontrolled exponential climb is the mathematical definition of a bubble phase.
Okay, so that sounds perfect for spotting a bubble. What's the catch? What was the limitation that made them look for something else?
The ADF test can flag that explosive growth, but it can't tell you which observation in that series is the actual bubble period. It's too blunt of an instrument. That's why the study moved to the industry benchmark, the Phillips-Shi-Yu, or PSY, procedure, specifically the GSADF version.
Okay, GSADF, that's the key. How does it improve on the ADF test? What are the mechanics?
So the GSADF is a recursive right-tailed test. The real innovation here is its flexible recursive sliding window. Unlike older fixed tests, this one is constantly moving forward and backward across the historical data.
So it's like a microscope that's constantly scanning across the market timeline. You can see these little fleeting bubbles that a static test might just miss entirely.
That's a perfect analogy, yes. And because it uses that recursive window, the GSADF is really good at handling nonlinear patterns, structural breaks, across very long time periods. In the study, they applied this to monthly S&P 500 price dividend data from 1940 all the way to 2023.
83 years.
Exactly, 83 years. And this let them detect multiple distinct bubbles within that history, not just the 2 or 3 most famous ones.
And that long historical view, that's what gives you the ground truth. So once this procedure flags an observation as having an explosive root, that observation gets its true label for the model. And initially, this was just a simple binary label, right?
Correct. At first, it was just, is bubble or not bubble? They found 128 observations that were bubbles and 813 that weren't. But then the researchers did something really crucial. They moved to a multi-label classification.
And why is that distinction so important for anyone who's actually trying to trade or, regulate these markets?
Well, because a simple is bubble label is almost useless to a policymaker. You need to know, are you riding the wave up or are you about to go over the cliff? So they split the bubble observations into 2 classes. Is bubble asset creation, that's the euphoric part, which they call bubble up, and is bubble financial collapse, the panic phase, or bubble down.
That makes all the difference. Knowing you're in a high-risk environment is one thing. But if the model can predict that inflection point, if it can tell you whether the growth is still building or if the collapse is imminent, I mean, that's what turns this from an academic exercise into a valuable early warning system. That's what saves portfolios.
Exactly. So with those labels established, the second step is all about collecting the predictive variables. The study groups these inputs into two buckets: the hard quantitative macro fundamentals, and then the softer behavioral data from financial news.
Okay, let's start with the macro fundamentals. These are the classic sort of slow-moving levers of the economy. Can you break down the top three for us? And maybe, get beyond the acronyms.
Of course. First up is GDP, gross domestic product. It's just the total monetary value of all goods and services produced in a country over a specific time. It's the main metric for the health and size of the economy, the engine.
The health of the engine, got it.
Next is the BOP, or balance of payments. Think of this as the country's financial scorecard with the rest of the world. It tracks all the money flowing in and out from trade, from investments, all summarized in a few key accounts. A strong BOP suggests strong international financial health.
That's a great way to put it. Okay, and finally, CPI.
CPI, the Consumer Price Index. This is our main measure of inflation. It looks at how much a standard basket of goods and services is costing the average person. It's key for monitoring purchasing power and monetary pressure. So those three, plus interest rates and unemployment, formed the quantitative backbone.
So we have output, international flow, and inflation. Now let's pivot to the behavioral data, the financial news sentiment. This is supposed to represent the short-term mood of the market. Where did they get all this text data?
They compiled financial news from major sources: Bloomberg, Reuters, the New York Times, starting in 2010. But crucially, they only focused on news related to the largest companies, the ones that contribute over 50% of the S&P 500's earnings. So your Apples, your Microsofts, your Amazons, they filtered out a lot of the noise that way.
Smart. And how do you turn thousands of articles and headlines into one number that an algorithm can actually use?
They use a specialized natural language processing tool, a pre-trained model called finbert-lc, and this tool converts the text into a single number, a polarity score. It ranges from -1 to +1.
And that score is mathematically pretty transparent, isn't it?
Yeah.
It's just the probability of positive sentiment minus the probability of negative sentiment.
Exactly. If the model reads a headline and is, say, 90% sure it's positive and only 10% sure it's negative, the polarity score is 0.8. And that provides the behavioral signal to go alongside the hard macro data.
All right, so the labeling is done, the data is stacked. Now for the main event. Which engine is strong enough to process all this and spit out a reliable warning? Let's talk machine learning.
Right. So the final step is using what are called ensemble methods. The whole point is to maximize robustness. An ensemble method doesn't rely on one single prediction. Instead, it combines several weak learners, usually simple decision trees, to create one strong learner that's much more accurate.
Okay, so let's unpack the two main types they looked at: boosting versus bagging. They sound like terms from a boxing match.
And they really are powerful competitors. Let's start with boosting, using models like XGBoost. Think of boosting as a team that learns sequentially. The first model makes a mistake, and the next one specifically trains to correct that previous error. Each new model is built to fix the errors of the one before it, which means misclassified data points get higher weights. It's a very aggressive way to improve accuracy.
And bagging, something like a random forest model. How's that different?
Bagging is more like running independent assembly lines in parallel. The models are all fitted independently using slightly different random subsets of the data. Then you just average their results. This approach is fantastic for reducing variance. It helps avoid overfitting, so the model isn't just memorizing the past.
So after putting all these models to the test, which one came out on top for predicting bubbles?
The results were very clear. It was extreme gradient boosting, or XGBoost. It consistently got the highest F1 score, which is a key metric here, and it maintained an accuracy of 0.98.
Now, for those of us who don't follow machine learning metrics every day, why is the F1 score so important here? Especially when you're dealing with something rare, like a market bubble.
Because the F1 score balances precision and recall. Since bubbles are so rare in the data, 128 occurrences over 83 years? Accuracy by itself can be really misleading. A model that just always predicts no bubble might be 90% accurate, but it would be completely useless. The F1 score makes sure the model is good at both catching the signal, that's recall, and ignoring false alarms, which is precision. It's exactly what you need.
Okay, this is where it gets really interesting for me. Once XGBoost was the clear winner, they looked at the features, the inputs, to see what was actually driving those predictions. What was the big finding there?
This, I think, is the knockout punch for relying only on market mood. The dense, fundamental, quantitative predictors were just overwhelmingly dominant. GDP, balance of payments, and CPI were the top three predictors, full stop. Together, they accounted for more than 75% of the total importance score.
Hold on a second. You're saying that the big macroeconomic fundamentals, the stuff that governments and central banks obsess over, were nearly 4 times more important for predicting a crash than the constant 247 stream of headlines from Bloomberg and Reuters.
Absolutely. The news sentiment, that polarity score, it was the clear underdog. It ranked dead last, 7th, across all the ensemble models. This really reinforces the idea that for long-term systemic bubble prediction, the fundamental health of the economy just trumps the immediate behavioral signals you get from the news.
Well, why? I mean, why would sentiment be so much noise? You would think human psychology is at the heart of a bubble.
The thinking is that news sentiment is just too noisy and too short-term. You know, a massive news cycle about Apple's new product might skew the sentiment score for a month, but that volatility doesn't really reflect the deep, multi-year divergence from fundamentals that truly defines a bubble. The things that cause systemic collapse, like sustained trade imbalances or an overheating economy, they move slowly, but with massive leverage. Sentiment tells you what's happening today, but macro data tells you what structural flaws have been building for years.
That distinction, structural flaws versus short-term noise, that is a huge takeaway. But let's get back to the application. The real test is its ability to predict the rarest event of all, the bubble down, the collapse itself.
And this is where that multi-label classification really proves its value. The XGBoost model was incredibly successful, even on these rare classes. For the Is Bubble Up class, the asset creation phase, the model achieved an unheard of 100% F1 score.
A 100% F1 score for the creation phase. So the model correctly identified every single instance where the market was entering that explosive high-growth bubble phase. For an investor, that's the model telling you exactly when to ride the wave.
Precisely. But what about the collapse? The bubble down class is even smaller and much harder to predict, and yet the model still performed really well. The confusion matrix showed remarkable precision. There were only 4 actual historical collapses that it failed to predict.
I see a note here about varying the decision threshold. Now, this sounds like pure methodology, but it seems like it has some huge practical implications. Why is adjusting that boundary so crucial?
It's crucial because that threshold determines your risk tolerance. The standard approach, just using a simple rolling mean to define the switch from up to down, it just wasn't sensitive enough to really capture that inflection point.
So if the model predicts a bubble is brewing with, say, a confidence score of 0.6, that's an alert. But if you move that boundary down to 0.4...
That's it, exactly. By lowering the boundary, the study found a threshold of at least 0.4 was sufficient for a robust, accurate split between up and down. This means a cautious regulator or an aggressive trader can actually tune their own system. Adjusting that threshold from 0.5 down to 0.4 means you get an earlier warning. You might sacrifice a tiny bit of precision, but you gain reaction time. And when a market is collapsing, reaction time is everything.
That flexibility really gives it real-world utility. This has been an eye-opening deep dive. For you, the listener, I think the core conclusion is pretty clear. This 3-step approach is highly robust, but its predictive power is just overwhelmingly driven by the foundational economic reality. GDP, balance of payments, and CPI. Financial news sentiment. It's really the noise, not the signal.
Right. And the finding really refocuses the conversation on underlying economic health. It offers extremely valuable, quantifiable insights for anyone trying to mitigate systemic risk before it spirals. It gives them a measurable reason to intervene, grounded in hard data, not just market mood swings.
Which brings up a great question for future exploration, one the paper itself suggested. If U.S.-centric financial news ranks so low, what if we broaden the scope? Future research could look at cross-market extensions, at international economic links, to see if global financial news provides the missing behavioral link that could enhance these models. So, something for you to mull over until our next deep dive.